Hello, my name is Tyson Ray, and I'm one of the founding partners here at Foreign Wealth Advisors, and I have the privilege of presenting our mid-year update. We titled the series Forming Perspective because I think in this day and age, especially with all the information out there and all the media frenzy to try and scare us into things, having perspective is one of the most important things we can do. Our series is titled Forming Perspective because we think having perspective in this day and age is very important. And I have the privilege of talking on behalf of my colleagues. Rick Elson is in our Kenosha office. Christine Hayward is in our Middleton office up in Madison. And Luke and I are here in Lake Geneva. Also, a little disclosure, this is information that we've put together from multiple sources. This is not any opinions per se of Raymond James. They act as our custodian and give us a lot of financial tools and financial services that we help our clients with, but they did not put this presentation together. So we hit it. We've entered a bear market, defined as the market from a high to a current low drops more than 20%. You're going to see a bunch of grizzly bears really looking mean on financial magazines to try and make sure that the media can cause fear and anxiety and try and scare some more people out of the market. But bear markets are very common. In fact, they happen about once every 5 years. And this slide kind of lays out the history of them. And what I want you to see in this slide is that here we are, we've dropped about 24% top to bottom in the first 5 months of 2022. And what I want you to see in this slide is that the downswings, these bear markets, are both shorter in time frame, shorter in duration, and not as severe as the upswings. And we'd like to say that I'm not worried about a 20% decline or a 30% decline. I'm worried about the next 100% advance. And where we were worried about COVID, and in 30 days, the market sold off 34%. The market rallied about 100% here before we had this pullback, or go back into the financial crisis. You've had a pullback and then you had a huge rally. And this advance that we don't want you to miss by panicking out of your investments looks like this. The client that panicked out of the financial crisis, waiting to get back in, hoping the market would go back down to that level, misses often in advance. And so where market downturns, at least historically, this may be the first time ever that the markets never recover. But from a historical standpoint, these market downturns feel permanent, but they're temporary. And if you react to them and take a temporary downturn and get out, unless you get back in below where you got out, you actually lose money. Same emotions that cause you to panic out of your investments are then justified when the market goes down, so it keeps you out. And the psychology shows that those emotions don't change back until the market goes back above where you got out, which means you took a temporary downturn and made it a permanent loss. And the loss is at whatever point you finally decide to get back in. And history shows you better get back in pretty quick, because here we have an example going back to COVID where we had extreme down days, in some cases down 10% in a day, followed by extreme upswings. What history shows on a 20-year time horizon is if you just miss 10 days of 20 years, so you miss 10 days out of thousands, you actually cut your return in half. And so you can't panic out of these investments. And the way you do that is don't have everything in these investments and make sure you have cash cushions, have a plan. But bear markets are normal. Let's not overreact to them. And let's talk a little bit about why. So this actually happens to be the worst first half. It's a new headline that's out there in financial media going back for several decades. And so we're finishing the first half down about 20%. And we don't know what the second half looks like. What we do know from a historical standpoint is it's a mixed bag. Again, there were previous years where the first half was followed by another downswing. But what I see in this slide is the higher the downswing, the more likely there was recovery. recovery in the second half. And so we'll see what happens in the second half of this year. There's a lot that's going to play out, especially what we know for certain is there's going to be a result of midterm elections, and that should basically create what is currently an uncertainty into a certainty, and the markets like those things. But historically speaking, again, from a quarterly standpoint, here is an example of bad quarters. And again, here we had a bad quarter in 2022. For the second quarter. Don't know what the next year is going to look like, but bad quarters have often been followed by good years, with the one exception of the tech bubble, which had another downswing there after 9/11 happened and then recovered from there. But if you take a time horizon, which we're not investing clients' portfolios for any one quarter, half year, full year, it's a lifetime portfolio. If you change your perspective and give yourself time, it's amazing what happens when you play out a 3-year time horizon, a 5-year time horizon, a 10-year time horizon. But this is what we're talking about. We're talking about long-term investing. It means you can't in any one day, week, quarter, month overreact to something. You can't think in terms of all or nothing. And yet you might say, but what about recessions? That's got to be different. Well, not really. The COVID recession lasted only a few months. And historically speaking, most recessions last less than about a year. The only exception was the Great Depression. And quite frankly, back then, there wasn't technology to get people out of their investments as there is today. There were rules back then that you could make $1,000 investment and only have to put $100 down. Well, if that investment dropped $200 or dropped 20%, if that investment went into a bear market, you lost your $100 and then you owed the bank $100. And then because back then there wasn't FDIC insurance, the banks just shut their doors and 4,000 plus banks went under. And so we've learned a lot of lessons from that would prevent that from happening again. And that's what humanity does. We learn lessons, put rules in place to try and prevent those things from happening again. But what I want to show you is that this recession, if it happens, is going to be inflation driven, and they tend not to be huge recessions, at least historically. But let's look at what recessions look like as far as the market. 6 months before recessions hit, this is a representation of returns, and they're all over the place because recessions happen for different reasons. During the recession, same thing. You have returns all over the place. But again, what I want you to see is go out 1 year, or more importantly, go out 3 or 5 years out. Again, a recession is a wonderful opportunity for a purification of our economy, to get rid of excess, to allow us to learn some lessons, and more importantly, to allow new investors the opportunity to step into these markets and allow those of us that are no longer adding to our investments to just hold on and ride out the markets, knowing that by rebalancing portfolios like we do, in recessions or in these downturns, we may take dividends or interest and buy some of these things that are down. We may rebalance, which is by definition selling what has done well, what is high, and buying some of what is not doing so well. But we're going to take care of that. What I don't want you to do is make an all or nothing decision. So I want to talk now about inflation, because that's one of the hot topics of why we might go into this so-called recession. And inflation is basically the fact that things are costing more, prices are going up, and so therefore the value of the money we have is going down. Inflation hits you in 2 different ways, depending on how you look at it. So let's look at it from the standpoint of, you want to leave a certain sum of money at the end of your life to your family, or have an estate that's a certain size. And so if I want to have $100,000 to give to someone 25 years from now in an estate, at 2% inflation, that $100,000 becomes worth $61,000. Or let's assume you want to leave $1 million to your family when you pass away at the end of your retirement. Okay, well, that $1 million, if you just left it in the mattress, would be worth about $600,000 at the end of 25 years. At 4%, it gets not only cut in half, but then some. It's only worth about a little over $375,000. And so the reason we make investments is to maintain what we call your purchasing power. It's not making investments to try and get rich quick, to try and make more money for more money's sake. I have clients that feel very comfortable that they have enough money today wonderful. But if you don't invest that money to combat inflation, the money you feel comfortable with today may not be enough 10, 20, 30 years from now. Why? Because if we switch the focus over to, let's assume we want to buy something into the future. Let's assume that you want to, like you helped fund your kids' educations. What about your grandkids' educations? Let's assume $100,000 is what would cover an education, or that's how much money you want to allocate to an education. Well, if the child's just born 20 years from now, you're going to need at 2% about $150,000. And look at this, at 4%, you're going to need over $200,000. And so we just know that things cost more into the future. And by investing, what we're trying to do when we're investing is we're taking money, which by definition is units of a currency, currently US dollars. We're taking that money and we buy units or shares of companies, usually in diversified investments. And why do we do that? Because history shows, and over time, by owning these companies, we get to participate in those companies' profits, so that 5, 10, 15, 20 years from now, when opportunities present themselves to sell those units at higher prices, we can sell those units or shares and convert them back into more units of currency, AKA more money, to then pay for what is costing you more. That's the sole reason of why we're investing the way we invest for clients, both why you accumulate money for retirement investments and why you live off those investments in retirement. Is because things cost more. And boy, do they ever. This is a chart that basically shows that after a decade or so of having basically 2% inflation, after a decade of the Federal Reserve trying to get inflation to go higher and get to an average of 2%, we got it. And we got it in both facets, because we are paying more as consumers, we feel that. But the black line represents what businesses are paying to create that which we consume. And so it's on both sides. And that's why it's a little more sticky than it is in the past, because in the past they've yinged and yanged each other, but these are pretty straight lines. As this chart reflects, we're peaking here in July. The expectation in the next couple of months is that this should turn itself down. And that would be good news, especially for those of us that are experiencing inflation at the pump. I would tell you that just seasonality of gas prices, the gas prices should be at about their all-time highs right here in the middle of the summer. They historically trend lower. One of the things that's a big driver of inflation, obviously, is the gas, but it really is the byproduct of the war in Russia. And again, we went into January and we had this spike in oil prices because of the Ukraine-Russia war. I'd like to talk about that war for a minute. One, Russia oil production had been declining anyway, and now that they are basically being banned from doing business in Europe and a lot of the NATO countries, they're looking to now go sell their oil somewhere else, and China is the likely buyer. What I'll point out, though, is that China is not a producer of oil, and their consumption has been increasing by about a 2 to 14% growth since 2019. They are taking in about 16 million barrels a day. And Russia only can produce about 9.5. And so Russia and China are friends, but China's got to play nice in the rest of the world economy to get the oil and energy that they consume. And at the same time, the United States has been growing our production by about 10%, and we've only been consuming about 1% more. And in fact, in this last year or two, we continue to be skirting on this energy independent, where we can produce as much as we consume. And that puts us in a pretty strong position. But like in the past, they talk about inflation. Inflation is high in oil because we've gone from where we were in COVID at $11 up to over $100. But that's not anywhere near where we were back in 2008 with the financial crisis, when oil was almost at 150 and projected to go to 3. So if we used inflation going back to that point, gas prices and oil prices are basically just back to their all-time highs. Said differently, on a 10-year or longer term time horizon, the inflation of our energy is basically flat. And so I don't want to lose sight of that. Yes, from one year to the next, we've had this increase in inflation, but it's whether or not it becomes compounded going forward that is the worry, not that we actually just had it. So what does inflation also affect? It also affects interest rates. And interest rates are driven by the Federal Reserve and how the Federal Reserve sets a standard called the Fed funds rate. And then the marketplace then prices other fixed income investments based on that rate. To combat the increase in inflation, the Fed has been very aggressive in raising interest rates. And where usually they would take a couple of years to raise rates over time, they have basically spiked in 2022 to the projections that it's going to look like it's going to be the fastest rate increase in the last 30 or 40 years. When interest rates go up, the value of fixed income interest rate sensitive investments go down. The reason for that is if I have, for example, a bond that pays 2% and now the Fed raises rates and so there's a bond out there paying 3%. If you're going to buy my 2% bond, you're going to pay less for it because you can get a 3% bond. And so fixed income across the gamut of fixed income options has dramatically underperformed. It is unbelievable the damage that's been done on the fixed income space. We actually had been expecting this for a while, going back to the COVID crisis. And even before then, we had been overweighting the equity side of the market, expecting at some point this whole zero interest rate environment that we've been in, really coming out of the financial crisis, eventually needed to correct. And I think this is the catalyst that's causing this correction and really should be a reset going forward in the interest rate environment. And I say that because basically the Fed is telling us that we have these increases. They were projected to go, the Fed is projected to go to 3, almost 4%. Now, as things are coming in line and we're starting to see some signs that the economy may be slowing a little bit, now that we're seeing the market actually has sold off 20%, which, by the way, if inflation is prices are too high and the Fed wants to calm down or lower this inflation by dropping the market 20%, that's a lot of progress in that direction. Now there's some other things that need to come in line. And so the expectations have come down a little bit, but this is the uncertainty. How high are they going to go? But it's uncertainty relative to the past, right? Because basically going back to a 3% interest rate takes us back to where we were in the late 90s and most of the 2000s before we had the financial crisis and stayed artificially low for too long, possibly. And so what I want to offer perspective on is when you put inflation and put interest rates together, because basically you have an investment opportunity in fixed income where you give them money and in the future you get your money back. And along the way you get to take this income, which is the interest that the investment gives you. Well, what you got to remember going back to inflation is if you put $100,000 in an investment and you leave it there for 20 years, at 2%, it comes back to you with the same 100,000, but it's going to buy less. Its purchasing power declines if you're living off that interest. What this chart shows is the interest rate inflation, what you really experience. And what I mean by that is that if currently interest rates are currently floating close to 3%, and yet inflation's close to 6%, then your real return isn't 3%. If you're what you're really going to be able to buy into the future based on that return has to be adjusted for inflation. And what I want you to see here is that the concern is that we've been basically in a negative interest rate environment for a while. And in fact, coming out of the financial crisis, it's been basically flirting with a negative interest rate environment for years. The concern is, are we going to go back to something like we had in the 70s? I don't think so. I think it's more likely that this is the phenomenon that was created because of COVID and because that was a turn on, turn off scenario that we should be able to fix this. But what I want to show is that when we're making decisions about how to make investments, this is part of the decision process. Because if you're going to make an investment in fixed income, I want it to be an investment that gives you a real return, meaning net of inflation. You actually have a positive return. And you have to go back before the financial crisis really to start getting back to a positive return. Everybody remembers the late 80s where, okay, you had interest rates at near 10%, and if inflation was 3 or 4% back then, you could have a positive real return of 5-6%. Coming into the 2000s, it was rare that you could get any return north of 5%, and we've been in really low real returns for a while. And what that simply means is the person that doesn't want to have an investment in equities that bounces around, but offers a return for that volatility that's greater than inflation, that offers you a net real return greater than your fixed income alternatives. If you don't want that volatility, your portfolio or your wealth is slowly losing its purchasing power. And your peace of mind about seeing your portfolio secure in value is going to be upended in 20 or 30 years when you realize that I have this money, but it doesn't buy what it used to. If I move on now from interest rates and inflation, I want to talk about the federal government and how everybody's worried about how the deficit spending and all the things that are going on in the government, and we should be worried. But what I want to point out here is that as COVID hit, we had this huge spike like we've never seen. Going back to the financial crisis, they did quantitative easing, they tried to bail out things, and the upswing was minor, and then it flatlined for a while, corrected, and then here's COVID, and we've just never seen anything like this. And in fact, at this peak, they wanted to pass massive spending bills, and thankfully there was some wisdom that prevailed to put a pause. In fact, there was a senator or two that started talking a year ago about inflation that's now shown up. And we've seen some of the spending back off as basically the COVID spending has expired. But what I also want to show you here is as the economy has boomed, as the unemployment is low, as wages have increased, there's also been a huge increase in revenues. And what I want to see is I want to see these two lines come back in line with each other, because that's going to help, one, put our spending and our deficits as far as our country back in line. Again, there's only been one time in the last several decades that we actually ran a surplus, and it was the latter part of the 1990s. But these lines have trended each other, and where they've separated is where we've run our deficits. And so what I'd like to see is this line come back down and maybe continue its trend, and this line get closer to it, so we basically can afford what we're doing. But what I want to tell you is don't buy some of the arguments out there that raising taxes is going to grow the economy to pay down the deficit spending. I would rather see that the deficit spending comes down in line with revenues, because the more we have to pay in taxes as people, the less we get to spend in our economy. That long-term will slow down our growth overall. One of the other things the government has done that I think is a big driver of inflation and no one really talks a lot about is they just injected a ton of money. They call it helicopter money, where they basically just went to everybody when they shut the economy down and basically gave businesses money, gave people that couldn't work money. And it was to probably keep the American people calm while they figured these things out. But the amount was just unprecedented. And what this chart is this chart's a reflection of basically what's called M2, which is a money supply. Think about all the money that you own in your bank account, that your friends own, your family owns, all the citizens own, businesses own. It's the cash that we all are sitting on in banks. And it historically has grown, and it's grown historically in track with the economy, which kind of makes sense. As you make more money, you'll have a little bit more in the bank account. If I create a business, I'm going to open up a bank account. If my businesses grow, my bank reserves grow because I need that cash to run the business. Well, COVID hit and we just spiked. And when you give a lot of money into a system and then you shut down the system and then turn bits and parts back on, we got to go spend all that money in specific areas. And that's what's driving a lot of this inflation. The expectation is that this needs to stop this upward trend for inflation to stop going higher. And it looks like it might have turned over a little bit on itself, but we need more time to figure that out. But what did we do with all that money? Well, you might as well find a new currency to put it in, right? You've got all this money sitting out there. And what's interesting to me is the cryptocurrency phenomenon really took off at the same time all that money was given to us in that COVID era. So we were given a bunch of money and we bid up the prices of these cryptocurrencies. And now at the end of 2021, they basically shut off some of that money. And guess what? These prices are now falling back down, because to keep the prices up there, you got to keep the buying to support those levels. And what people don't realize is that cryptocurrencies have not even scratched the surface on how we as a world transact businesses. These are transactions by the second. And you could add almost every cryptocurrency together and they don't put a dent in how we transact business. But what we have found is they put a huge dent in the amount of energy we consume. In fact, just the mining, which I'm not going to bother trying to explain, to basically let Bitcoin be Bitcoin and run, Bitcoin, the currency, cryptocurrency, consumes almost as much energy as the country of Sweden in a calendar year. And so this is not an efficient way to transact business, especially given the fact that they're not transacting that much business for the amount of energy they're consuming. So I don't think until they figure some of these things out that these cryptocurrencies are really going to amount to much, and they are certainly not an investment that I want serious wealth in. So let's talk about people and consumers and investors. Well, first and foremost, you all feel horrible. This chart is a sentiment survey that's out there, and people feel the worst they've felt in some 40 or 50 years. People felt better coming out of Vietnam. People felt better coming out of the 70s oil embargo. People felt better when we were fighting wars in Iraq and Afghanistan. People felt better than even the financial crisis that lasted years, or the tech bubble, or 9/11. This is an unprecedented negative mindset that's out there. And I think the media is feeding it, right? If people are upset, then give them reasons to be upset about it. It's crazy. But what I want to point out is, again, people in masses make silly decisions like buying a bunch of toilet paper they don't need. And what I want to show you is, if I just go back and point out, here's the Gulf War, the first one. We went to war in the fall of 1990, and our sentiment dropped because as a country, we're going to war. But what I want to show you is 12 months later, the market return from that low point was a positive 29%. The lowest point in COVID, the market recovered 43% when we were all worried. And so now the market's down 20%, down with the feelings that we're all upset. Okay, what's going to happen in the next 12 years? I have no idea, because this doesn't guarantee anything, but it does show me that every time for the last 50 years that everybody felt horrible, a year later, that was an opportunity for someone to take advantage of. And I think that's what's going to take place. Why? Because the consumer is in the best financial shape they've ever been in, if we even go into a recession. Their net worths are the highest they've ever been. To put that in perspective, go back to the financial crisis. The net worth at the high was about $85 trillion. It lost, it went down to about 74. We are double that now, a decade or more later, and yet we feel horrible. I don't understand. We have some of the lowest debt service ratios because of the low interest rate, all the mortgages that people were able to lock in at these lower interest rates or refinance. We have never been in better financial shape, but somehow people feel horrible. Additionally, we've gone from hoarding cash. So COVID hits and you can't spend any of it, and they give us a bunch. So you have this huge savings increase. And then we spent it as they opened the economy back up. Then COVID hit again in the fall, where it really, on a numbers basis, captured us over that Christmas and holiday season. So we had a spike again in COVID. So we all started saving again. And then COVID subsided, the vaccinations got put out there, and we finally coming back to a normal trend. This downward trend of cash being spent is what also drove inflation. You had people spending all this money that they've sat on. Well, if we go back to a normal trend line, we should get back to normal inflation. But as far as consumer finances are concerned, they are some of the best we've ever seen. Debt service ratios at some of the lowest levels we've ever seen. What this shows is that the average American is using less of their cash flow to service debt, which means that they have more money to spend in other places, and puts us in a better situation than when they were maybe over leveraged in the financial crisis. But interest rates have risen, mortgage rates. And yet, again, we're just getting back to some perspective here. We've gone from under 3% to over 6% in less than 6 months. And we're all upset about it because, hey, getting a mortgage at 3% was amazing. This is the average 30-year fixed mortgage rate going back 40 plus years. And what I want you to see is that coming out of the financial crisis, again, because interest rates were low, it brought mortgage rates lower to let us mop up the inventory that was out there in the housing crisis. They got so low here that in the last 6 months, they've gone from below 3% to almost 6%. This is a chart that shows the 30-year fixed mortgage rates for the last 40 plus years. And we've been spoiled for the last decade or so, because coming out of the financial crisis with low interest rates, you had mortgage rates bouncing around between the 3 to 5% range. And in fact, after COVID, we got down below 3 for a little bit. But with the Fed raising interest rates and the expectation that that this lower rate environment is over, in 6 months, you've had the 30-year mortgage go from below 3% to almost 6%. Now, what I want to point out is before the financial crisis, we funded the financial crisis with mortgages at 6% or higher. So it's not that people can't buy houses, but this crazy advance in the real estate market, which adds inflation, which makes housing cost more, by raising mortgage rates will slow that down. It kind of looks like this. Here's the spike in interest rates. So the rising of interest rates, especially with regards to mortgage rates, is going to make housing harder to buy. So we're less excited about buying homes because they're effectively going to cost more than they did 6 months ago. So existing home sales is going to go back down a little bit, because I may not sell my house to go get a different house because I may want to stay where I'm at, especially for those of us that have these mortgages locked in at 3% or lower. And so therefore, the increase that we're seeing in housing prices should start slowing down, or maybe flatline for a little bit. I don't expect to see this huge decrease in value in real estate prices. I expect more to see kind of this trend sideways here a little bit. And the reason for that is because this is housing starts. This is how many homes we're building. If you go back to the financial crisis, the reason there was a correction in home prices is we overbuilt. And so here's an example where we were building on average about 2 million homes a year. And economists tell me that the number is about 1,500,000 homes a year we need to build to keep up with population growth. For a few years, we built an extra year or two worth of inventory. And why did we do that? Because back in the financial crisis, before the financial crisis, it wasn't one person owning one home. You had one person owning 3 or 4 homes. Fast forward to today, after this downturn in housing starts and never really getting back above this trend line for so long, we have a housing shortage. And so now you have 3, 4, 5 people bidding on one home. The lower interest rate environment fueled some of the desire of buying some of that home. And so we should expect this to, again, also slow down a little bit with the mortgage rates going back up. But that's a good thing, because it should keep these housing prices from going into the stratosphere where people can't afford a new home, or especially a starter home. So put all this together, you have a lot of things going on behind the scenes that can cause confusion. But I want to go back to, again, everybody feels bad. And when you feel bad and you're upset and you're afraid of this uncertainty, you have reason to make an emotional decision. And it can be a painful decision long-term if you make the wrong one. And so, yes, gas is high. Yes, mortgage rates are high. Yes, inflation is high. Yes, the market's down 20%. Yes, the Fed is raising interest rates to try and fix that. Yes, people are worried about a recession. And I think most people are afraid. And what happens when most people are afraid is if people finally get to the point of wanting to panic, and I feel the markets, day traders, hedge funds, actually try and create pressure to push the market down farther to get to this, which I haven't seen yet. I've seen it several times in my career, but I haven't seen this yet, which is just the panic. It's just, get me out. I don't care anymore. I don't care. I got to save this. I can't lose anymore. And that often is the bottom. And the people that are wise investors don't panic. I don't care how bad it gets. Warren Buffett says, be willing to lose 50% of your investment at any one time, because people panic and cut these investments in half, their prices in half. I would argue the underlying company still has value. And actually, as the price of that company goes down, the company itself, I believe, is actually more valuable, which is why we don't want to sell those investments when they're down. But we can't allow our clients, we can't allow you to panic out of your investments. And the reason why is, over the last 20 years, coming out of the tech bubble, the financial crisis, COVID, you name it, the average investor dramatically underperforms market investments because they get in and out at the wrong time. They barely keep up with just fixed income bond investments. And again, when you bring inflation into these returns, you actually aren't, the average investor isn't making a whole lot of money unless they are participating in the volatility of the market that they don't want or like. But that is why they get rewarded long-term, because you have to be rewarded for taking that risk or no one would take the risk. So how are these businesses and companies doing that are down 20% or more? Well, they're going through what I would call a normal business cycle, where they basically recover from COVID, they expand, they have a bit of a slowdown. Now the question is, do they go into a recession or not? And what I would tell you is where recessions happen, this was one of the better market cycles from a return standpoint, and we never had a recession. There's been times in the past where we had a slowdown and then we expanded, then we had a slowdown, then we expanded, very similar to what happened in the 1990s. It happened back in the 1960s. Now, recessions can happen, but they don't last very long. What happened coming out of COVID is you had a lot of people going, wait a second. They had time to think. They were working from home, and they thought, hey, let's start a business. And you had this explosion like we've never seen before in American entrepreneurship and business ownership. And what did that do? That created an explosion of job openings like we've never seen before. There are millions more job openings than there are people looking for work. And again, if we go into a recession, those two lines may come back in line with one another, but it's not anything like we've seen in the past, where back here we have more people. This is a very different environment than we've had in the past, where you had more people looking for jobs than there were job openings. It basically, if somebody wants a job in America right now, they can definitely go find one. The other thing that they want, if they're going to go back to work, or what people are looking at, is what are they making? Because after many years of having a trend line of about 4% for wage growth, we finally had this spike in increased wages. Now, it's being paid more to keep up with inflation. And in fact, with inflation being as high as it is, people aren't really feeling that they're getting ahead. They're still not getting enough. They're scraping by. Coming out of COVID, to get people to go back to work, we've had to pay them more. Again, people have more wages, therefore they have more money to go buy things. Inflation has now actually gone higher than the wage increases, which again will start slowing down people's ability to consume things. So even though I have more money in my paycheck, I still can't afford the higher gas prices, or I still can't afford some of these other things. And so I'm going to have to slow down my spending. So that's going to slow down demand. So that's going to slow down inflation. One of the greatest things that's going to slow down inflation is if the average consumer just sits on their wallet just for a little bit. That will have a huge impact on inflation. The rising interest rates will have a huge impact on inflation. And again, this is something that I think we're going to see subside in the next couple of months. But inflation has already had its hit on the investments and on the markets. We've had this 20% decline. And this is a valuation chart that shows, based on the underlying earnings of the company compared to their prices, how valuable are these market investments now. And where coming out of COVID, they had quite the rally, and they had some earnings to back it. They were starting to become overvalued. Now, we didn't know how long they were going to be overvalued. So coming out of COVID, after this huge correction, the market shot up, but the market shot up before the earnings caught up, which is why the valuations got extended. Now, very quickly in the last 6 months, they've corrected back down. And I don't believe we're going to go back down to the financial crisis levels at all. And the reason I don't believe that is because the companies themselves are telling us that their earnings are going to increase. And so if their earnings are going to increase, eventually people are going to realize, wait, these businesses are still making money. And so therefore there's still more value there to basically put a bottom underneath this market cycle. But going back to the 1990s, the Gulf War, going back to the tech bubble, going back to the financial crisis, going back to even COVID, you had a decline in earnings, but they didn't go to zero. And this upward trend of earnings, of the profits these companies make, is reflective in the upward trend, long-term trend of their prices, which is why we want to participate in the ownership of them, because I believe you can make more money owning these companies, participating in the profits the companies make, than you can in the interest rate environment that we're in. Collectively, as an economy as a whole, going into the financial crisis, we got ahead of ourselves. And then it corrected. And then we followed that trend line again, got right in line, COVID hit. And now we recovered. And now inflation may be slowing us down a little bit, but I don't think this trend pattern is going to stop. I don't think America is going to stop consuming things, which is the biggest driver of our economy. And again, I just think we need to get some perspective. So I really want to drive home again how market returns work, how volatility works. I want to talk about how you feel and what actually happens. And so there's a lot of numbers on this chart, so I'm going to point them out. This is a chart that reflects what happens in any inter-year calendar year with the market. And so here in 2022, we've dropped 24% so far as a low. As of the July 15th, we were only down 21, so it's recovered a little bit. Let's go back to, here's 1987. You had Black Monday. The market dropped 20% in a day. So when people tell me that the markets are too volatile and it's never been like this, the market dropped 20% in a day, one day, back in October of 1987. The top to bottom decline was 34%. And yet, had you not panicked, the year actually ended up +2. Fast forward to COVID, the market went down 34% at the beginning of the year in 30 days, but it ended the year up 16. But what I want you to see is every year the market had some high and then had some correction before that calendar year snapshot. Very rarely did the market end the year in a downtrend if there was a downtrend. But what I want to tell you is this is what you feel. You feel this, I'm losing, I'm losing, I'm losing. If you're always judging your highest value and not the money you started with. I'd also want you to realize day in, day out, week to week, month to month, quarter to quarter, that's not what long-term investing is. That's day trading, that's gambling. I would encourage you to not pay attention to that, because what's amazing to me is 10 years out of the last 40, 1 in 5, the market finished down. There was only one time in the last 40 years that the market had down back-to-back years, and it was the tech bubble, and it was 9/11 and a recession that followed in the Afghan war. This may be the 11th year. We'll find out. But what I can't drive home enough for clients that have a 10, 20, 30-year time horizon, the markets are up way more than they're down. And I believe it is the downturns, and specifically these downturns, that create the opportunity for panic, that create people that make mistakes, that make these upturns possible. What I know is looking at actual volatility of the markets is the opportunity. Because if you go back to the 1950s to today, your worst one-year decline is 39%, and that's no fun. And that was the financial crisis. But your best one-year return was 47%, and that's what people feel like is gambling. But if you go back and look at 5-year returns, you almost lose the entire downside, at least looking backwards, but maintain quite a bit of the upside. If you look at 10-year rolling returns, it almost goes away entirely. And on a 20-year time horizon, your worst compounded return was 6% for 20 years, and your best was 17. And your average of all of this was 11. Now take inflation out of 11%, and you have a positive real return over a long period of time, which is what we're seeking. All right, so to land the plane with future guesses, I want to talk about what people are thinking going forward. Let's start with what they thought at the beginning of this year. As I said, in this perspective that we put it out in January, the perspective this year was supposed to be flat, that the last year or two in COVID had done so well that this was going to be a year that we're just going to digest that. And so the average expectations with the market ending the year at 4,700 and change, that the average is going to be down a little bit. And down it is. In fact, here's Raymond James's projection that we ended June here at that 3,700 and change, down about 1,000 points from where we started the year. And yet their base case is we should be a little higher as we end the year, because we got to digest this inflation and the interest rate changes and the midterm elections and kind of get that uncertainty behind us. Their best case is that we'll go back to their all-time highs that we had here. Their worst case is that, nope, we're going to have a panic and a sell-off. And that's what I want to talk about. I don't want us to participate in that. And at the same time, I'm telling you at the end of the year, based on this example, in their best or base case, not best case, they're telling us we'll have a negative 17%. Okay, well, we've had a couple of those in the past 40 years, not many. So 1, we don't have many of them. 2, we don't have many of them back to back. And so maybe, just maybe, we should ride this out. So going into next year, the base case is that they think we will get back to about 4,300. Again, best case is we should get back above that all-time high. We're basically looking at 6 to 12 to 18 months of just trending sideways, bouncing around. That's going to give us opportunities for those of you that are retired to try and in the upswing, set aside the money that we need. We may use some of the reserves that we have. My goodness, for those of you that are still able to add to these portfolios to take advantage of the dollar cost averaging opportunity that's going to be there. But again, we're not making these investments for the next 6 months or even next year's projection. Why? Because we're making them based on this projection. Raymond James and the same research has said the next 12 to 18 months is going to possibly be sideways or down or up. They expect the market to double in the next 10 years, getting a little bit past 2031. And they're using an 8% earnings growth, compounded growth rate for that. And they're using a growth rate of about 8% for that, an earnings growth rate of about 7%. And why is that? Well, because that's actually a historical trend. And even if we hit this low that they may be trying, we go into this bear market, they still think we're going to basically double from here. And it's that, again, as I said in the beginning of the slide, I'm not worried about the downturn. I'm worried about the permanent advance. That permanent advance, I would like to have our clients participate in. And to, again, put it in a much longer term perspective, if we go back again to the 1950s, we have companies compound their growth rate around 5 to 7%. And Raymond James is simply stating that with this low interest rate environment, it may be closer to 8. For the last, going back to the 1950s, we have companies grow their earnings about 6.6 and the price is about 7.9. So for Raymond James to say, hey, we think we're going to grow at about an 8% price and we're going to have about 7% for earnings growth rate. Yeah, that's what history shows. That's the opportunity. And if the market goes down below that, if prices go down below that, that's how much more they got to recover if those earnings end up happening. And the good news is companies tell us what they think these earnings are going to look like. Now, that's not guaranteed, but coming off of a 50% increase of earnings, which is turning the economy back on, they were expecting 10 this year. They're expecting 9 next year. And they're expecting 8 the following year. It's not 0. And why can this happen? How can we continue to grow at these levels? It's because of this. It's because of middle class, not Americans. It's middle class people around the planet. North America was projected to only have about 10 million new middle class members. Why do we think we're going to have these growth rates? Because of the emergence of a growing middle class of consumers on our planet. America is only going to have about 10 million. New middle class consumers coming into our economy. But look at Asia Pacific. India and China and the rest of Asia are projected to have over 1.4 billion people coming out of poverty and getting into a middle class. And what do they want? They want a cheeseburger, they want a house, they want a car, they want jeans, they want a child, they want diapers, they want bottles, they want life. They want to go live it. And what do other humans do? They find products and services that all these people want to consume. They need it. They'll go to work to earn the money to buy it. And what do those companies have? Those companies have profits. What are those profits? Those profits offer returns often greater than the interest rate environment that we're in. Because historically speaking, I want to participate in those profits because that yields the return that we're seeking to help you have what you want to consume. And so within the TR Best models for a while, we have been overweighting the equity markets. And again, the reason for that is we haven't seen value in being overweighted to the fixed income. Doesn't mean you can't have it. And if you want more of it, we can give it to you. What I want you to see in this chart is the fixed income component is not providing the safety net when we want it. And so this is a conservative allocation, which is a little more 50% in fixed income and a little less than 50% in equities or ownership of companies. And this is the opposite. This is an overweight or aggressive portfolio. So you have a conservative portfolio here that is an overweight to fixed income and an underweight to equities, ownership of companies, or aggressive portfolio where that's an overweight to equities and a substantial underweight to fixed income. And then you have the returns. But what I want to show you is in the financial crisis, to some extent in the Christmas of 2018 when the market sold off, and especially now, the difference of going down 14% or going down 17% through June of this year is the same experience. So that fixed income didn't give us any protection against volatility. And I'm of the opinion that technology going forward that allows people to panic, they're selling everything and going to cash. And if they're just going to sell everything, the volatility that you're going to pick up in fixed income that historically had not been there isn't worth it. Especially when you go and put these things next to each other and say, okay, the difference between fixed income and the difference between an aggressive portfolio, or the difference between overweighting bonds or CDs or interest rate investments versus overweighting ownership of companies, is the difference between a 6% return and a 9% return for the last 20 years. Keep in mind that the fixed income interest rate was much higher in that 20 years than it's probably going to be in the next 20 years. My opinion is, if we're going to take more risk, if you're going to take more ownership of equities, you should get more return for that risk. That's what this slide is telling us. The slide is telling us that because we're having more volatility in our portfolio, we should get more return. And what I'm realizing is we're starting to get more volatility in fixed income and we're not getting the return. So what's the point of owning it? That's why we've been overweighted to the equity side of the market. And what is the difference in the last 20 years? The last 20 years is just a 3% difference compounded over time is $180,000 more of a $100,000 investment. $100,000 investment at 20 years at 6% got you a little over 300, and at 9% got you almost to 5. The 3% on average compounded over time, a little difference for more volatility, but a difference nonetheless compounded over time, made an enormous difference, a 59% increase. A little difference compounded over a long period of time will make a life-changing difference in your retirement, in the people that you love. It can help make your life better. It can help you give money away to the community, especially when I don't find the certainty that people want to have in the fixed income space is going to be there in a rising interest rate environment. The other thing we've seen throughout history, if you want to go back even further, and it's even further with better interest rates, on a 35-year time horizon, if you don't want to have any money in equities, you can expect about a 3% withdrawal rate in retirement. So if you have $1 million, you can take about $30,000 or expect to live off about $30,000 and be able to preserve or not eat into that $1 million. And that's true across the board of how much you have either in bonds or in equities, either in fixed income or 100% in companies or some combination thereof. But what I want you to see is, what if you want 4%? Well, if you want 4% and you want to be 100% in fixed income, you're going to more likely eat into your principal. You need to start adding things that can produce returns greater than fixed income, which is owning the companies and participating in their profits. And you actually can get to about a 4 or 5% distribution before you start really risking a withdrawal rate that would eat into your portfolio over time. And so that's why we're doing what we're doing here at Forum Wealth, and we're trying to help more people do it. We're trying to help basically take your money, take your life savings, take your nest egg, take and understand, what do you need to have in the bank to live off of? And we define that as near-term needs in the next 3 to 6 months of a cash cushion. So what do we do at Forum Wealth? We start with understanding what's at the bank. We want to understand what your cushion is, what your emergency fund is. It's anywhere from 1 to 6 months worth of near-term needs. Then we're going to talk about what kind of cash reserve should we have. And the cash reserve in investments is basically like your bigger emergency fund, and that's 6 to 24 months of known needs. So if you know in 15 months you're going to need a specific dollar amount, I don't want that in a long-term investment portfolio. And anything 2 years and beyond, that will then get allocated to the investment portfolio. Only after we know we have the money in the bank and we have the cash reserve funded do we allow the investment portfolio then to do its job. And the job is this. 6 months ago, when the markets were out their all-time highs and we needed to basically start looking at the next year or two, it's to take some of those profits and go and fill back up the cash reserve account and the bank account of our clients that they tell us they need. And if those buckets are full and they don't need it, then we don't need to sell anything. And though we don't like the market that's sold off, we don't need to sell in the downturn, which is the #1 rule of investing. Do not put yourself in a position to have to sell when the market's down. And the only way you can do that is planning. And that's what we want to do with you as a client, is to plan, what are your cash flow needs? For those of you that are retired, it's the reverse. We want to make sure you have the money in the bank, in comes the paychecks, That should only build to a certain level. Then we'll have the cash reserve for what you need for the next 6 to 24 months as another reserve account. So we'll help set a system in place that if there's this much money in the bank, then we're going to fill this bucket up. And then when the cash reserve is full, and we can identify in the next 2 years why we would need any more money that you have, that's when we start making long-term investments. And the greatest mistake that advisors make, in my opinion, is they try and blend this all together in one portfolio. They try and blend this all together in one account, or they forget that the most important investment decision a client needs to make is what they shouldn't have in investments, period, because of what they need in the next 6 to 12 to 24 months. And our job at Form Wealth is to try and work with you to understand what those needs are. We have a whole team to do that, and then bring perspective of what you need to be doing and not doing in times of uncertainty, in times when a lot of people are panicking. So I want to thank you for taking some time today to let us offer some perspective. On behalf of my colleagues, I also want to thank our clients for entrusting us with the opportunity to try and help you navigate these markets. And if you're not a client, why don't you give us a phone call and let's have a conversation about how you might need to have a different perspective going forward with your long-term investments.